Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Wednesday, May 3rd, 2023. It is 11:49 a.m. Eastern Time, so I figured we've got enough time to get one video out before the all-important FOMC rate decision. So just to recap, quarter-point hike is baked in the cake. I have very little doubt that they'll tweak their their comments, a statement when Powell comes out and does his press conference at 2:30, as well as the initial statement they released right at 2 p.m. Along with the rate decision. They will most likely change some of the verbiage in their statement, and of course the media will pick through there, but they'll probably kind of go into that more wait and see mode. I doubt they're going to say we're outright done for now, because they're never going to box themselves in a corner. But again, it doesn't even matter. Let's just see what happens, what the market does. I didn't check today, to be honest with you, but the odds were so high yesterday, over 90% for that quarter point, that we're almost certainly going to get it. Like I said, some kind of a no hike at all would be a huge shock to the market. It could send things flying up, and could send things flying down. I really don't know, but my guess on that, if it did, it would be an initial surge to the upside, followed by reversal within the next day or two. And then, look, I want to just say this too. Say at every FOMC meeting, especially the big ones, interest rates years, in over the past decade or so weren't as important. We were at zero rates. There was no really chance of a big move, and inflation was, most importantly, inflation has been under control for really a half a decade now. So we are in different times, and as such, these Fed meetings and what the Fed says and does are super significant and relevant to the market. So with that being said, what I wanted to say, which I say on all these Fed meetings, is, don't overreact or think that the initial reaction is going to stick. Just like earnings from a company, quite often the initial knee-jerk reaction, whether it's a sharp up or sharp down, quite often that's reversed, and even then that subsequent move in the other direction's reversed. It's noise is what I'm trying to say. I call it post-FOMC noise. And so best thing to do, especially if you're risk averse, is lighten up. That's what I've actually done. I'm day trading. I've given you those trades. I'll get to that in a second on the little 5-minute charts, 60-minute charts. And I'll be taking some shorts into the meeting, some swing shorts, some core positions, but nothing heavy until, again, as I've been saying, until Apple's out of the way tomorrow and the Fed's out of the way today. And then on that too, I did see a comment on the site recently that some are bullish right now, and I get that. And hey, Randy, can you share some long side trade ideas? Absolutely. I'm gonna couple things on my radar, but I will, especially if things start going to the upside after Apple reports and into early next week, and if and as that bearish case starts to chip away, most certainly I will get out to you as many attractive looking trade ideas as I can. I want to say this: I never try to force it. I don't have a minimum number of trade ideas I'm going to share with you every week or every day. If you follow me for a while, my analysis and my trade ideas come in spurts. And there are times I'm firing off posts, you're getting 5-6 emails a day, and the next day as well with new trade ideas. And bottom line is, when I see opportunities, and that's how the market works. It is not an ATM in which you can extract money from on a daily basis. Maybe that's what the algos do and the trading firms, high frequency trading. But my style is, you'll have to wait and see. It's kind of like, I always use the analogy, like an ambush predator. Whether it's a python sitting in the grass, somewhere, or a cheetah waiting for a gazelle to come within range, because if it chased after every gazelle that walked by, it's going to die. It's going to expend all its energy. So it waits for those nice setups where it sees a weak one or a young one or something, and it's in the right distance, and boom, that's where they go. Same thing with the stock market. You have to be patient and wait for whatever it is you're trading to come to you. And then there are times where it rains, it pours, and then there are periods of drought where the trade ideas are far and few in between. So I just wanted to share that. And again, I've shared plenty of trade ideas recently. Most on the equity markets were short and bearish, because that's my views and that's what I'm seeing in the charts. I'm also giving you some long trade ideas. particularly commodities and other things that have a lower correlation. But all right, enough on that. Let's get to the charts here. So this is the trading range. Remember yesterday we fell back in the trading range, and we fell right to where I figured we'd go. That midpoint line I have at 317.60. Hit that. Again, this is the active trading stuff where you could have covered a short there, game the bounce, and then there's been multiple trades. I'll get to that in 1 second. But see, this divergence is still here. It's still here on the 60-minute chart. This is a messy board, but it's still here, very much so on the daily chart. I'm talking about the negative divergences. And when you go to the weekly charts, you still have some of the long-term trend indicators bearish at this point in time, which indicates to me this is most likely we're at the tail end of a bear market rally here. All right, so that's that. The zero down, for active trading, I got this post. I encourage you, if you are trading anything, whether it's wheat, whether it's NQs, if you're in active trading mode, when you see a 5-minute chart like I started posting yesterday with the NQs, that's for active traders. Swing traders and trend traders, really ignore those. That's not your thing. But if you're actively trading and interested in QQQ or NQ or whatever I'm posting, just check back into that post. I posted here. It's been actually longer than 16 minutes now. Refresh. Whenever it was, you can see the time stamped 11:34. And we hit this support. Remember, that was yesterday on the bounce. I figured we'd bounce from between here and here. And so that was, covered, the short there. That was the midpoint line on QQQ. And that's where, for active traders, so cover that short, game a bounce, and then scale out of those longs from here up to there. That was my minimum and max bounce target. So we hit that this morning, and it was good for a 0.5% pullback. And then the point is, I got you this one out. And again, this isn't going to make a front page post because this is day trading, active trading stuff. Sometimes I can do this all day long. I can do literally a dozen trades back and forth, long, short on NQ in a single day. And I don't share all those. Just remember these levels. If you're an active trader, that's what I'm sharing. Levels that are likely, support and resistance levels that are likely to come into play. And so that was it. So we were right at the that's the 13,175 resistance yesterday. Resistance once broken becomes support, and so far so good. That was again just not even 20 minutes ago, and so far so good for a bounce of and again, if you're a swing trend trader, you're not looking for these little 0.25%, 0.5%, 1% moves. But as a swing trader, and again, if you trade NQ, it's already leveraged up. You trade whether it's one contract or a dozen contracts, whatever your number is or more. You're putting typically thousands of dollars in your pocket if you can just game a 0.3% gain. So I just, in fact, I don't know if popped up in the lab, just hit my bounce target there, and I'm going light. I'm going lighter and lighter right now on my positions because we're heading into the Fed. So this is where, right here is where I think we stop, and I may actually, I'm going to pause this. Okay. All right. I'm sorry for you paused it. You didn't see it, but anyways, I had after gaming that, reversing right there, right above that 13,175. Closing the shorts, game that bounce again, which I got out to you, but you'd have to be in that, checking that post to get it. And this was my bounce target. So right before I paused the video, we got there, and I had me just small. I've gone down to like a fraction what I normally trade because it's Fed day, going to be. But I think there's enough opportunity to game it. I'm just keeping things small until after the meeting's over. But I did want to add some, so I had a close the longs and reverse. With interactive brokers, you can do that, and you have, whether your numbers, one share or one contract or 20 contracts of anything, or even shares and stock. You just put a sell order in to sell more than you own, more than your longs. In other words, if you had 100 shares long and you wanted to reverse short to 100 shares short when your target was hit because you expected a pullback, you just put a sell order in for 200, and it does that. It executes one single order, one single commission. Yes, probably one of the few people that still pay commissions, but it's more effective if you trade actively at Interactive Brokers and their free commission platform. But anyways, that's the likely bounce back target, and so we'll probably pull back down here, and then we're getting close to the meeting, and so came a little pullback, and then take what little amount I want to take into the meeting, which is going to be again a small fraction of what I will, much smaller than what I usually day trade, but even smaller than what I will normally swing trade. Because the risks are just too high that we pop one way or another. Even if that initial rally's faded, you have to use stop loss controls. It doesn't mean if we pop right after the Fed and it's a 2% rally in a matter of seconds or a minute or so in the indexes, it doesn't mean that that's all and it's going to be faded. You can keep going and you may never look back from that point. So again, just sharing things I've learned over the years. Keep it light. Or the market goes against you the way you think it's going to break, and you can see your losses mount up very fast if you have a heavy position on a Fed day. So keep that in mind. Okay. Normally I have enough that I can take home right now into the meeting. Okay, I wanted to move away from that, but I want to keep an eye on this just in case I decide to cover and reduce some of the shorts that I now have. So started the video long and now I'm short is what I was trying to say there. All right, next up, before I get to wheat, let me give you small caps. This is again an update to what I gave you this morning. We do not have on the S&P 500 or the Nasdaq 100 60-minute charts. There's the Nasdaq 100 right here. There's the S&P 500 ES E-mini futures. They do not have the 60-minute divergence. In fact, they're just coming off, as I showed you, in the Nasdaq 100 negative divergence. So right now, and I've been saying it for the last few weeks, the Nasdaq 100 is my favorite index to be short. I think it's the one with the most hot air, the most downside potential. And yes, it's been the strongest index. So, but that means little to nothing to me, and in fact, if nothing else, at this point in time, it leads me to believe that one has the most downside because it has been the strongest, because there was that herd mentality, and that tends to be the thing on Wall Street where the lemmings will follow the crowd, and again, this big tech, I think at this point in time looks most at risk for a big swoon down. Now, as I mentioned earlier, the Nasdaq, the Russell 2000 small caps did just put in a nice clean divergent low, positive divergence, aka bullish divergence, but I want to talk on this a little bit. Now, negative divergence in a downtrend, especially a larger long-term downtrend, i.e. a bear market, for example, has a much lower chance of playing out for anything. Well, first of all, it has a lower chance of playing out at all. Almost always in a bull trend, positive divergences play out, and they're often the catalyst for a move to the new highs. And I'm talking on the 60-minute time frame. But in a bear market, what happens is they do play out, and they're usually good for bear market rallies. This was a divergent low right here, and you can see the subsequent rally, and it was decent. It was tradable. Swing trade. We're in and out. That's what swing trading is all about. That was a 15% rally right there, so it's not like it wasn't worth it. For even a regular swing trader, it was quick. Then you put in a marginal new, but even a larger divergent low. So that's DL1 really, and then DL2, divergent low 2, because it's just an extension of the divergence that started back here at this point, right? So larger divergence and a much larger, or a larger rally. I always say it's not a set in stone thing and it's not guaranteed, but typically, again, not always, typically the ensuing move after a divergent high or divergent low is usually commensurate with the scope or how big the divergence is, and that was the case here. Bigger divergent low, bigger rally, right? Lasted longer, well, and it was higher in percentage gain. And then you can see a little small divergent high, some relatively small correction. Right here, you put in a bigger divergent high. That was that small divergent high right there. You can see my divergence lines. And then a bigger correction. So the other takeaway is you can see overall we're in a downtrend, the Russell 2000. This is our downtrend line here. So you've had these divergences, and they're good for a pop. And so far this one's been good for at least that much. And it may play out. There's a downtrend line. If we go up much higher, this downtrend line's, in my opinion, not validated yet. There are two reactions there, but they're close together, so I consider that one reaction when they're close enough like that. Second reaction. So if we rally up, we'd probably get a third reaction off there, and that would help to validate it. Then it's a trend line to watch at that point for a breakout, and that might trigger a long buy signal. There's also big support right here. Resistance about 1822 or so, and so watch for that. That would be bullish to see the Russell 2000 take out the trend line, and then again take out that I'll call that the BOD breakout level, benefit of the doubt. You want to see 1822 go. Otherwise, we are in a downtrend, and we get these little pops, and this pop or that one, if we get it, may be all we get. So that is kind of near-term stuff. So it's near-term bullish. I always say, and I've said it this morning, divergence is not a buy signal, just like overbought oversold is not a buy signal, but it is a condition, and it's a condition that usually indicates that the momentum is waning to the downside, and you're going to have a trend reversal. And then, by trend reversal, it's commensurate to the time frame you're on. A divergent low on a 5-minute chart isn't a trend reversal that's going to turn a bear market around, for something that's down 30, 40, 50% off its previous bull market highs. No, that might give you a day trade or a short-term swing trade. 60-minute chart, those divergences are usually good for at least several days or a week or so, and sometimes could be a couple months, somewhere in that range, right? It all again depends on the scope of the divergence and what's going on the daily charts. But now let me do this. Let me just jump over to the longer term charts. IWM is the ETF for the Russell 2000, and I'm going to show you the levels to watch. So there's that comparable downtrend line. I know it's a busy chart. I'm just going to highlight the key levels here. There's a downtrend line, a near to intermediate term downtrend line that you want to watch. And then that level that I just showed you on RTY, I'm going to move this line up. It's right about in line here. If you zoom in real close, there was a gap back here, so you have gap resistance, and then these reaction highs. So somewhere in that we'll call it about 180, and then right above it is a top of a gap at about 181.25. You've got the 200-day exponential moving average right there as well, and below it you probably cannot see it in this video. I can barely see it right now. It's a blue line right here, right in line with that 181.24, which is the 200-day simple moving average. Simple's there, exponentials there, and this is so this whole thing this is what I call a resistance zone. And so it's not one, it's a confluence of multiple key resistance levels coming in together. Okay, takeaway, bullish if it breaks out. Probably run up to here, about 180 here. I'll put a line for you there. You had a little trading range there that broke to the downside, and that would be your first stop. You also have a trend line here that could get back tested from below. However, bigger picture says, we're kind of really for almost a year now, close to a year, we've been in a big sideways trend. So we are in a bear market. There's no evidence the bear market's over at all in the Russell 2000. It's been a big, choppy, sloppy range, and that's it right there. You can see for months now. And this is what the small caps have been doing. So they're in my opinion, waiting to see which way the large caps want to break. So no one can declare victory yet, bulls or bears. Bulls can make the case we had a double bottom there, and that double bottom, those double bottom lows haven't been violated, and we're off those lows, whereas bears can say, yeah, but you're way off the highs, you're a lot closer, just in spitting distance from new lows and the small caps. And so if that breaks, obviously that's bearish. Then I look at other things like the indicators here. I see the PPOs down below the zero line. That often delineates bullish and bearish trends. Look at the white line, the 90 MA last of the two to cross. And when you're below, that often acts as resistance right there. So you got rejected. You took it out there right at the start of the bear market. You got rejected on the back test from below there. And a little whipsaw. But you remained below for pretty much all this period here. You had a nice bear market rally, very powerful there, and it told you this trend was bullish, bearish there. It's kind of been whippy, and that's the thing. When you start to get in a trading range, I put less and less of an emphasis on trend indicators such as this, because you're just going boom, 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 back and forth. The big picture, again, just to kind of reiterate, break of the recent lows should trigger in the next wave of selling, unless it's anything but a false whipsaw, a breakdown followed by a quick recovery. Whereas near term, I just gave you the resistance zone that, if taken out, starts to change things, at least in the near term. And like I said, that would be, doesn't mean it must go up like this, doesn't mean it can't fail, but net that would be a bullish thing to see that resistance zone I gave you before, I'm sorry, it was right about here, taken out. And then I go to the longest term charts. Let me jump over to a monthly chart, and you look at IWM, and you can see my one of my favorite longest term trend indicators on the monthly time frame, meaning every candlestick is 1 month of trading history. I have a 20-month exponential and a 20-month simple moving average. Those are in here in the blue and yellow lines, and they also do a pretty good job of defining the trend. The trend's bullish when you're above them, and they tend to act as support on pullbacks. When you break, the trend has changed. That was our last real bear market, and right after that started back in 2000, late 07. You broke it, you back tested from below several times, could not get through them, and got rejected after the multiple back tests for 6 months or so. And then finally we took them back there, and it said, hey, welcome to the new bull market. New bull market. We were in a bull market. There were certainly a couple corrections along the way, but for the most part, these lines were respected. Again, big correction there. That was every bit of a bear market. If you measure from top to bottom, it was a 27.5, we'll call it 28% drop, and so we were below it, and it caught most of it. Anywho, COVID, bear market, and it was over before we knew it because the Fed wouldn't allow it. But here we are again. I'm just trying to point this out because I get this repeatedly. Randy, why you're so bearish? Can't you see the trend? Again, a lot of my long-term, the majority of my long-term trend indicators are still bearish, saying that we're still in a bear market, and it's just a bear market rally. It doesn't matter. Yes, it's SPY and QQQ are above the 200-day moving average. That's one trend indicator, but it's more of an intermediate term. These are, again, longer-term trend indicators. And so as such, PPO histogram, that's red. That's a trend indicator. The PPO lines themselves, ROC 12, have a lot of trend indicators that are still bearish. And therefore, that's why I'm acknowledging that 60-minute divergence. And depending on what happens today, I may even start taking, as I mentioned this morning, you can take some RTY, small cap futures, or IWM. You can go long. It would be what I call an indirect hedge to QQQ short. It may or may not play out. Usually they tend to move together, but there are times where these indexes, the small caps and the large caps, can diverge. And so I just want to make that clear, because by an indirect hedge, it is very possible that both can go up or down together. And so if you want a pure play hedge on QQQ, if you're short QQQ, you buy calls on QQQ. I don't see the point if you're short QQQ going long. It's just burning up. Your broker's getting rich. I personally prefer the indirect hedges, as I mentioned, usually whether it's gold, treasury bonds, or sometimes two different indexes or things that typically run together. When I see divergence, then I look for that kind of mean reversion trade where they usually are running together, like the indexes, like small caps and large caps, and then there's divergence. Something or other is going to give. There's going to be a mean reversion where either the one lagging catches up to the one going up, or the one going up starts to go down and catches up there. Okay, hopefully that makes sense for you. Now on to wheat. Got a post out to you, and then I did an update. That's why I wanted to do an update here. I did an update on the site as well. Here, go here. That was the NQ update. Go home. And if you're in a trade and you want to get updates, you can subscribe to any one of these comment sections. Just go in, you want new follow-up comments or replies only to your comments, go ahead and subscribe to that, and that way if you did all comments, then you would have got this update that I gave you here, where next objective long entry or add-on has been triggered on the a break above the 626 resistance that I gave you this morning. That resistance level wasn't there yesterday when I when I put the setup, but charts are dynamic. That's what I always say. They're constantly changing. So then I noticed we had a little bit of support there. We broke it, back tested, got rejected. That helped to validate that level, and we were right there. And so we've since taken it out. So ideally, doesn't mean it's going to happen, but ideally, any pullback to that level should hold, and we should run up there. And again, it's just right now, just looking at it would be roughly almost about a 15% gain if T3 is hit. And the nice thing about it, I'm not so worried about what the Fed's going to say or what Apple's going to report with my wheat long position now. It shouldn't be affected much or at all. Very low correlation, and that's a whole part of asset allocation, diversification. So I'm just throwing out trade ideas like this, and man, that's it. I think I'll just wrap it up here, not make this a super long video. Remember, depending on which way this market goes, the VIX, just like, in my opinion, the stock market, especially the Nasdaq 100, is set up for a potentially big drop, a drop that can, by my current estimates, would be probably at least 20 and maybe up to 30%. Now it could have a smaller drop, but that's my swing trend targets and my next downside targets on QQQ. Bear market targets that were laid out in the beginning of the bear market. But the VIX also has the potential. You have divergent low. Remember that divergence? We had divergence there at that point. I pointed that out. Positive divergence. And it played out for, what was it, 60-something% rally, whatever it was. 78% rally. And now we have an even larger, the same divergence from that point that started back here has grown even larger. So again, by that logic, one would could deduce that the next up, if we do get an up, if the market breaks down, again, it has to click in. First thing we need to do at this point is go back. Let me go back to my QQQ chart. This is how I, analyze things. This is how I'll be trading the VIX. I've got some VIX, and then I'm long now, and I'll be a lot longer if I see what I like post-Fed and post-Apple. But the first thing that needs to happen right now is a break of the midpoint of the range. That was a tradable bounce because that was the first visit to the midpoint. Usually when you come off the bottom, you hit the midpoint, rejected, hit the midpoint, rejected, hit the midpoint, rejected, back to the bottom, back to the bottom. Finally, we took the midpoint out here. We did dance around it, but once we took it out, we never saw the bottom again. You saw the top, right? Then once we went to the top, traded through here a few times, but I wouldn't have put that line there if I didn't think there were enough reactions, and there were. And then the fact that we had a reaction on it recently further validates it. Okay, so now the next objective short entry, again, if it weren't for the Fed today, because there may be a whipsaw, you can take those signals on face value. All I can tell you is the odds of whipsaws both to the upside on bullish breakouts and to the downside on bearish breakouts are markedly increased on a Fed day. Okay, just take it for that. Doesn't mean they won't play out or can't play out. It's just that they have a higher chance of failing because of the post-Fed volatility. But what I can tell you factually is the next objective short entry or support level that would most likely trigger more downside is a break of that 317.60 or yesterday's lows, right? Then a break of the bottom of the purple range right there. Lots of reactions there, other than minus that one little whipsaw. And then I had the bigger box here in yellow, which is about 309.92, and that's really encompasses this whole month plus long range. It goes all the way back, and we entered that back in the end of March right there. So those are the levels, and so the way it works for me, if that gets broken, that's a sell signal and an objective entry. And when that gets broken, solid break, and that gets broken, the further we get away from there is going to increase the odds that QQQ is then going to continue a lot lower and come on down here to my next long-term targets, which remains the uptrend line. The blue uptrend line really comes in first. Next, there's the recent lows. I probably should add a line right here. You had that effectively about a double bottom in the Nasdaq roughly. And then if we overshoot the trend line, which is what I think is probably going to happen, I think we'd come down here. By the time we get there, no one will want to be owning stocks at that point. And we'll probably, if I'm right, this is where the waterfall selling will kick in. Once we start to approach those lows, all the bulls that think the bear market's over and that was the bottom, their stops will be hit. They will be a lot of them. I'm speaking, generically, not that a lot of traders will be forced out with margin calls, and that's one reason I think it'll be a pretty much a broad-based sell-off, and that's where the VIX would be exploding at that point if we get down there, especially if we undercut those lows, and that's my guess. Now the trend line does come in there, so keep it very simple for you. This is my next target range, and it has been since this bear market started. T4 has always been 235 and or the bluish trend line, because back when it started I figured we might be there around the same time, right? But what happened is we hit my third target, which was 268 and or this other white trend line right here, and there's 268. We hit that and then we bounced. So again, this is my next target zone, anywhere from there to there. Okay, and how do we get there? One step at a time. Boom, and then boom, and then boom. And the way it works for me is just, it doesn't mean the odds are 100% when this is broken, or 100%. There's only 100% when you get there. But the odds go up significantly, sharply. I get a little check mark for the bearish case when that level's taken out. Then my next check mark is there. Then my next check mark there. And at that point, if Apple and the Fed are out of the way and we're below there, I'll have my fill of short positions and feel more comfortable about it. Okay, I just had to pause the video one last time. Told you I was keeping an eye on that 5-minute chart. That's what I wanted to see, just pull back to that trend line. So covered those NQ shorts, and at this point in time, flat. I have no positions, and I'll probably stack some on before the Fed. We'll see. Again, if I do, nothing much, but I'm leaning towards going short in that. But you can hear my voice a little undecided. That's a gamble, and I don't, typically I place more calculated bets. The thing about it, the way I tick, the way my brain works with this is I've been looking for another move down for quite some time, and based really looking largely at this 60-minute trading range, and I would rather get stopped out, have a small starter position just in case it's a quick swoon down and I don't feel like chasing a sudden instant 2% plus 3% drop. I won't want to short into that if I didn't have a position. So I'll probably carry a small position in, and then just stop out. I'll have staggered stops, multiple contracts. Again, I've been keeping it very light today so far, and at most, maybe just a half dozen or so contracts going into the Fed. All right, guys, I'm going to wrap it up here and get the video out to you. And like I said, if anything else stands out, I'll let you know. Let's let the dust settle on the Fed a little bit. I don't think I'm going to fire anything off to you right away unless something crazy happens, and I don't expect anything crazy to happen. I think if we all know what the Fed's going to do, what they're going to give us, and what they say, give or take, I'm sure they're going to mention the concerns about the banking sector and things like that, and like I said, probably imply that they're going to hold and sit tight for now after this quarter point, whether they say it explicitly or more like an implicit kind of thing. All right, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.